Good morning, traders. It's Monday, April the 4th. Taking a look at the charts, we got the SP 500 futures here, the continuous contract. You can see we continue to do a slow burn. Friday, we saw a big sharp pullback followed by, or a big gap down in equities. The futures doesn't show that, but a big move down, and then of course it rallied up to new highs for the year. And of course, today we're continuing to see the stock market grind its way up. And this is what I've been talking about for a while. The market got really overbought over here. This is where we exited our long position. I talked about how it's going to start to get real choppy and really volatile, and that's what we've started to see. Now, if we take a look at the SPY ETF, you can see that a little bit better here. You can see the pullback, the big move to the upside, gaps, big gap down, big rally. We're getting into this choppy market, and we're getting into a previous top that if we zoom back, you can see we're getting in up into this area where the market is going to start to stall out, or it should stall out, put in a little bit of a topping phase here, and then eventually start to break down and roll over and move down. Now, according to the cycles, it looks as though we could top out this week, Thursday or Friday, and then I think we'll go into a sideways or right down into a bear market and see another leg to the downside to test these lows or go much lower looking forward as we go into May. So some pretty big price action. We're kind of holding off. Usually you get some of the biggest percentage moves right near the end of a move when you get complete short covering and panic buying. You get the kind of the extremes up at the top. You get the extremes down at the lows. So we're just kind of letting this market work itself out. We're holding back as long as we can before we take a short. It's nothing worse than getting short a month early and having to ride out much higher prices in a choppy price action when you can kind of wait for everything to top out and then get short, and more or less it'll be in your favor the whole time as it's kind of working through the final stages of a top. So that's kind of where we're at with that. Now let's jump over to precious metals. Gold and silver down slightly this morning, 0.2%. Continuing to kind of pull back. Overall, we had that big pop there based on the day that the Fed came out and created a big pop, and then we ended up taking a short play, locking in about 5% on our inverse ETF on that one day, moving our stop to break even. And the market continues to hold down. Now, if we take a look at the cycles for gold, here are the gold cycles. Now, if you're not familiar with them, long story short is these the blue cycles here. That is very short term, a mix of very short term cycles blended together. So it's kind of giving you kind of the weighted, the bias of the market short term. So when you see a big pop, you'll see the market usually have a pop. You see it drop, you'll see the market have some type of a little bit of a pullback. So that's where we're at. And we saw this pop in the market coming because we saw this big pop in this short-term index, and that's what we were looking for. The market broke down. It broke this support trend line that we were looking at right across here. It broke below it, and we were hoping to get one pop back up to the 1240 area, which we did with this cycle here, and then since then has been kind of moving down. Now overall, we took some money off the table because we had short-term cycles kind of going short-term low bottom in them, and we had a nice move within 2 days of that entry point, about a 5.6% move on our DZZ ETF. And now we got like a short-term cycle pop. So we might see the market kind of gold market try and hold up here. You can see the pink and the gray lines. These are longer term blended cycles. They're still pulling down. So they're going to have some downward bias. So we might see the market just trade sideways here and be very muted. Not so much of a short-term cycle bounce. But once that starts to give way, it could be a the later half of this week or next week, then we can see everything is in sync. We'll have the short-term cycle moving down and both longer-term cycles moving down. And this is where we're going to get into a significant low sometime later April before I think we could see a pretty significant bottom. Not keep in mind, cycles don't point to the price action where they're going, so don't expect price to fall to the 1120. The blue cycle here gives you a good idea. We're not seeing price move all the way down to the 1100 area and then rally all back up to the 1200 area. These are oscillating up and down from the top to the bottom of the chart, so we're just looking at the trend, the direction of the trends, not the price that they're trading at. Now let's just move back over to Let's move over to silver real quick. Silver, big down day there last session, kind of holding ground at the 20-day moving average and kind of a little bit of a pivot level here. Again, gold, silver miners, I think they're all going to move in sync together. Looking at the miners, you could argue here, we've got a topping phase where we're seeing the market put in a, whoops, wrong tool here, a shoulder, and then we've got a head, we've got another shoulder. It's got this rising neckline. And again, gold, silver miners are all going to move in sync pretty much. So once this level breaks, we're going to see probably a significant meltdown to the 17, potentially all the way down to the 16, 15 area. It could be a massive unwind. We'll see how it goes, but that's what the market is setting up for. That's what everything is kind of leaning at. And of course, everybody is extremely bullish in miners, so that's a great reason why they're going to lose a lot of money. If everybody's bullish, usually everybody's already bought in and they're holding, and now they need to be unwound and more or less taught a lesson not to stay bullish in an overbought market. Crude oil chart hasn't really changed a lot from last week's kind of prediction and cycle analysis. I kind of expect the price to kind of ping pong around somewhere down in here. I think it came down to this level actually, about 2% drop last night. It's kind of bounced back. It's actually positive on the session, but overall, I think we're going to eventually see it, I think, come back over the next couple weeks, 2 weeks or so, come back up, test these highs for a potential double top, and then I think it's going to flounder for a while, and then I think it's going to continue to go down into May. And uh, this big kind of extended slow grind back down in crude oil is going to keep some pressure on the stock market as it starts to make a major descent and potentially new multi-year lows. Taking a look at the VIX chart, we've talked about this last week a couple times. Uh, we are getting down. What we wanted to see were some new lows, and we saw this little. Let me zoom in a little bit here. We saw this little bit of a bear flag. We saw a big drop. We saw a 2-day pause, and I was talking about how we'd love to see the market keep grinding to these nominal new highs where we see a new high being touched, and then we see some big selling and this volatility. That's what we've been seeing. And of course, we saw the VIX gap up, but it came down and hit new multi long-term lows here, and it's dropped about 6% there on Friday. And hopefully, we see this continue to go down. But in the grand scheme of things, the VIX is getting down to this level in the past where it starts to become a pretty good opportunity for some type of spike play. Whenever it gets down to this level, usually a lot of the downside is already done, and it's just a matter of time before we get a big spike that could go to the 16, 20, 24 area, which is a massive return when the price is only at 13. So we're looking at, potentially 100% pop if we get a big wave of fear. And of course, if you're using a leveraged inverse ETF or a bullish ETF, sorry, some pretty good gains can be made. But again, you don't want to be trading the VIX when it's trading up in this area. So many people, when volatility is high, you got to be careful because the VIX can move very fast in either direction. But when the volatility is low and it's been grinding itself, we could see a massive spike with very limited downside. The only real downside to playing the VIX, as long as you can wait for it to get down into this really low volatility area where it's hard for it to make new lows, the only thing that kills you really is the time. The leveraged ETFs for the VIX decrease in value over time. So even if the VIX stays at the same price, the leveraged ETFs keep falling in value substantially, like pretty quick. You can lose several percent a week just if the VIX doesn't move in your favor. So very tough to play when when the volatility is high, but when you get down into these levels, it's a great play going forward. And I'm going to be looking to do that. I'm not going to jump on it just yet. I'm going to see how things unfold this week, but I think we are getting very close to some significant plays, a long-term inverse play on the stock market and a potentially short-term spike play in the VIX. Anyways, that's it for this morning. Talk to you in a little bit.